Ladies and gentlemen of the crypto space, we're live at 11:29 a.m. on February 16th. It is a Tuesday. We had a day off. Equities markets were closed yesterday. Crypto markets were not all weekend. Absolutely fascinating experience across the board. The bullishness is in the air, and we have to understand and look at the macro financial components that are contributing to the prevailing market price action, the very obvious market sentiment across the board to really get an understanding of, is it more likely than less likely to experience continuation? Is there a topping pattern? Is there downside price action that can be expected? And that's kind of where I want to head with a lot of the conversations that I have and the topic definitely of today's stream. Does it really matter if it's really, really bullish? Don't you want to be prepared for the downside and protect everything that you've worked so hard for, everything that you've tried to make the best decisions possible to achieve? You should always have guard. We got locks on doors, locks on whatever. Everything is protected. Passwords, usernames, triple action security. We have to be prepared. And the interesting thing is there's products in the legacy financial system that facilitate this kind of risk management strategy. Downside protection. You sell in puts. You're more aggressive. You buy out of the money calls to the downside, or so on and so forth. You could do a variety of option strategies, straddles and whatnot to account for price action volatility. And that's very centric to legacy financial systems. But what's so fascinating is we're involved with the crypto space, and such concepts are being pursued. Oppian and other and synthetics has some options action, or definitely at least inverse synthetics that they expose us to. So these are considerable types of components to add to a portfolio to provide balance or appreciation facing a downside in the market. But I personally choose different strategy. Primarily based on observations that I have about products and technology that has been emergent in the DeFi space since early last year, very specifically. Anyway, we're going to get into this. Today's title is Euphoric and Bullish. Don't neglect risk management. And basically, that's the point of my opening monologue. Protect your stuff. You work way too hard. Today's episode sponsored by Change Angel, the non-custodial swap exchange for social goods. Stop depositing on exchanges, not your keys, not your crypto, non-custodial, DeFi, or nothing at all. Bam! Let's pop it over to the main screen and see who's in the stream. Got Igor in the house, Squanchy's in the house. Yeah, Craig's in the house. Winner in training. Did the intro get cut or did I miss something? I hope not. I'm pretty sure everything's recording normal. OBS looks good to go. Good kilobits per second. CPU and FPS are on point. So yay. Igor, Digibyte appreciated. Yeah, Digibyte's good to go. There is serious technicals to consider. Interestingly enough, I don't think I would not apply value to it right now. It doesn't meet my technical criteria for allocating value. This is an extremely inflated market as compared to 2017. So to tick the boxes of bullish confluence, you need to be above at least the long-term moving averages, 200 EMA, SMA, and the long time frames, which would be the weekly for Bitcoin, given its long history. So that'll probably put it around 14 to 18 cents, which is quite interesting because that's either at, near, or above the dollar all-time high in 2017. And that's just a really fascinating reality that it's not bullish technically until it actually achieves such a price point, and that's specifically considering its denominator, which really should be Bitcoin, because we are interested in the assets that are outperforming versus underperforming. And unless Digibyte is outperforming Bitcoin, you want to apply the value to Bitcoin. But if an altcoin is going to outperform, that's when you consider allocation to not Bitcoin. Best set. Otherwise, it is the better asset to hold in the portfolio, the one that is outperforming. Value transfers from inflated assets to uninflated assets. And that's basically it. So the value of Bitcoin sometimes transfers to altcoins, and vice versa, creating an equilibrium. And that's basically the concept of mean regression. Then we get into the whole macro conversation when I talk about with the broad equities market and commodities and the whole great value reallocation event. And that's always a fun topic for another time. Graham's in the house. Hello, everyone. I promised my kid lockdown takeaway Bitcoin hit 50K. So I got the Bitcoin chart up. Now, do note, this is the Bitcoin chart that I look at. I don't look at dollars anymore. I'm done with dollars. That's just ancient history. Albeit I do have the DXY up, so what the heck am I really talking about? So I denominate my Bitcoin in QQQ, which is basically broad Nasdaq. And that's just what I have come to the conclusion is the most important chart right now to understand the relative valuation of Bitcoin. Bitcoin is already broken out against the S&P, oil, gold, TLT bonds, and silver, no doubt, and uh, more interestingly enough, Bitcoin is significantly outperforming gold. And I pulled up another chart. I'm still trying to wrap my head around the significance of it. So Bitcoin denominated in USD, denominated against the DXY, which is Bitcoin is just vertical. It's significantly outperforming the DXY. And since the DXY is dollar against an aggregate, a basket of foreign fiat, I'm not quite sure the conceptual, philosophical significance of that chart, but whatever. It's outperforming it. Bitcoin is literally outperforming every asset class except this chart. This is the chart I call the final boss. Right now, since Bitcoin is outperforming everything, this is telling quants and other data analysts, especially on Wall Street, where to allocate value. Because value is allocated in a risk-on fashion to markets that are outperforming. And if Bitcoin's outperforming everything, value is going to be allocated to it unless they are negligent and not performing a fiduciary responsibility for the clients that they manage funds for. So this is the final boss. I say that because since it's outperforming everything else, if this is the last one, it's not significantly outperforming. This will have significant impact on quantitative analysis of the broad markets to understand the state of Bitcoin. Is it really outperforming everything? And that's going to change everything with regard to what these data analysts recommend to. Based on empirical data for the fund managers to take action on. So based on 2017, let's zoom out. I want to show you guys one of the most interesting observations I could have about this chart. We'll go to the weekly. It's a couple years back. So relatively speaking, I think this chart is the most meaningful. I'll elaborate. Nasdaq is historically beyond measure inflated. It has attained the valuation that is like 200% market cap to GDP. This has never occurred before. It's distorted beyond rational measure. So Bitcoin, compared to 2017, has barely exceeded its a breakout. So bear in mind here. So check it out. I'll explain what I mean. See if I could draw one line. I'll do a horizontal line over here. So if this is the previous top, how do I tell you guys, how do I try and teach you guys how to look for bullish confluence? Is the breakthrough resistance to the upside, the retest, and the higher high. So that's exactly what this is right here. This ascending triangle is basically the retest and the attempt to print higher high. As you can see back here, that's on the 4-hour. So that's basically where we are. So the retest and the higher high print. So, and this is obviously a resistance that's significant. So once this breaks through, it'll affect the psychology and empirical data that analysts provide to the fund managers. And this is where all the folks in the crypto space, the very intelligent ones, willy woo and whatnot, say it's just going to consume everything. And Raoul talks about that too. It's a black law of capital because of network effect. As more and more people apply value, it's going to outperform, and something that's outperforming draws in more value, and before you know it, it's literally outperforming everything. Therefore, if you don't apply value to it, your value is being left behind, sitting in, not depreciating, but relatively depreciating, not outperforming assets. And this gets into a very interesting conversation when you talk about like a risk off event and the function of bonds and the function of gold. And you always want to make sure your value is allocated to the asset that's most likely to outperform. Otherwise, you're going to be left behind which exposes you to value loss. Anyway, let's see what else is in the stream. Um, uh, Graham talking about Digibyte is literally the missing link. Fundamentally, I always talk about Digibyte, and I don't need to rehash that narrative. Um, uh, Fundamentals tell you where to look. Technicals tell you when. That's the bottom line. Don't take risk unless they have bullish confluence. I don't think it's a prudent course of action. You want to have assurance that something is more likely than less likely to continue bullish appreciation. Barry says, Digi, my good old catchphrase. Trevor, any recs on app or website to track yields, fee earned across all AMM protocols? I think that Santiment is probably going to be a good place for that. I recommended to them on Twitter. I want to see value flow in and out, the gross aggregate of AMMs, and it gave us a great indication the other day that we were going to have a depreciative event. Basically, this giant wick to the downside, this red wick, was a big liquidity event, buy side imbalance, and that's what happens when there's an imbalance in the market. You have significant depreciation or appreciation. In fact, this market is remarkably healthy. Other than a couple of wicks, I mean, look at this price action. Even this upside is not all right. I don't want to be too happy talk. So this not healthy when you see a giant wick to the upside like this. That implies that there's volatility. That implies that there's a market imbalance, either a supply side or a buy side deficiency. And it's not a sign of a healthy market, but when volatility leans in your favor, everyone likes it. It's appreciation, but you're not going to like it when volatility leads in the other direction, and you have these giant red wicks to the downside, which are quite painful. This is why we look at the technical, so we see a trend formation. Trends continue until they stop and reverse. The trends continue until they're either confirmed or invalidated. In which case, when you have these giant wicks to the downside, you're like, what is it going to do? Is it going to hold or is it going to fail? If it failed, you were looking at what was that? Probably 45,000, a couple $1,000 to the downside to reach the most reasonable next trend. Obviously, you had price action support around here, price action support around here, and trend support over here, along with the 50 SMA on the 4-hour. My daughter's saying hi. Bye, honey. Daddy's doing live stream. Anyway, so you always want to protect about the downside price action. And in the crypto space, as I was hinting earlier, we don't necessarily have the amount of options products that we really need to protect as such as we historically did in the legacy financial space. There's no in the money options. It's sparse to say the least, and just generally not a lot of folks selling the options for persons to buy for downside protection. What's more important, I think, is the AMMs. I think the AMMs are widely misunderstood, and there's two general ways AMMs are built. You have the pools, which have pairs. Obviously, you have Balancer, which has a whole other concept in play with the multi-assets. And then you have Bancor with the permanent loss protection. I think for generalization purposes, the two diametrically opposed concepts are most pertinent to talk about, which is pools, which have a pair, and Bancor, which focuses on single side exposure. So if you want exposure to the full upside potential of an asset, you're talking about single side exposure. You're talking about holding an asset, literally raw. But Bancor, with their permanent loss protection, you could hold the asset, pop it in a bank or a pool, have full upside and downside exposure to it while also experiencing the incentivized and trading field yield. Which is great, and that has a place in a portfolio. But interestingly enough, that has more risk than the paired pools. Paired pools experience impermanent loss. Permanent loss is grossly misunderstood. I strongly look at impermanent loss as an option straddle. It's going to mute both the downside and the upside, as well as compensate with incentivized and trading fee yield. So that has a significant part in a portfolio, specifically with regard to risk management. It's an option straddle. It's going to mute the downside as well as the upside, which basically reduces volatility in favor of a recurring revenue stream. And I think that's extraordinary. So you don't necessarily even need an option anymore to still be exposed to upside and have very meaningful protection to the downside. That's really cool. Badger DAO, Badger, and Dig Token seem to be doing well with Bitcoin. Upper price action, great to see alts not dump on such movement. Yeah, I like Badger. I think their partnership with Yearn is has quite a lot of potential, specifically with regard to Bitcoin based products. I'm not allocated to Badger at the moment. I think there's potential for their curve pooling, and I'm not entirely sure because it's a secondary level DeFi type product. So it itself is not providing lending or borrowing or transactions, but it provides the game theory component. It has incentivized supply disruption as well as an inflationary, most likely a deflationary yield component, a decaying deflationary yield component. So that's the game theory that's very effective, that has proven in the last year to be at least a mechanism for value creation, a type of monetary policy, and that's what how I've been talking about a lot. What's occurring in the DeFi space, comparing this to basically what sovereigns, what countries used to do historically. They were the ones responsible for crafting monetary policy, implementing it, distributing it, and enforcing it. But DeFi in the last year has shown that software can execute strategic monetary policy, and what has occurred empirically is the testing of those monetary policies for effectiveness. Effectiveness for what? Value preservation, value retention, value creation, value distribution, liquidity. That's crazy. That's crazy because they've done in DeFi in a matter of a year what sovereign countries haven't done ever. So there's probably been, Jared Tate will talk about it better than I. There's probably been about 5 iterations of the dollar over the last 100 years, at least to the best recollection of conversations I've had with him. But how many iterations of monetary policy have occurred in the DeFi space in the last year? A couple thousand, hundreds. And the best part is they're extraordinarily mutable, enhanceable, iterable, modifiable, tweakable, customizable, coupleable, stackable. That's crazy. So I know a lot of folks think of this as like alt season and think of 2017 and think of price go up and all that stuff. But when you peer through the surface of market price action and investment opportunity, value allocation opportunities, what you're seeing really is something that makes it not like what happened in the past. This time it's different. We're talking about monetary policy experimentation, value creation, markets and technology that parallel and mirror legacy financial products. Literally, an AMM is a bank, produces it has created the vast majority of the functionality of a bank, but instead of a bank making the return when you provide them liquidity, the Digibyte protocol propagates that return directly to you, which is exactly what BlockFi and Celsius do, and now Gemini to a lesser extent, probably because they're pursuing insurance, much like Cresco Fin. But yeah, BlockFi and Celsius, they're disrupting the banking system from a centralized organization standpoint, redirecting the vast majority of yield to the depositor, and the AMMs in DeFi do that even more. It's like they, other than Uniswap, Uniswap takes all the profit. Whereas with Curve, there's a 0.04% redistribution. Is it point? No, it's 0.02. It's half of the transaction fee. 0.02% redistribution to VCRV holders, and uh, 1inch has its governance. I think it's 20% you're getting nowadays. I'm pretty, but I think Bancor is going to do profit sharing, but you're not given anything whatsoever from a bank. Whereas with these DeFi protocols, not only do you get transaction fees, not only you're participating in a value creation process involving um, uh, uh, incentivized yield, incentivized supply disruption to receive that yield, and strong game theory enforcing meaningful deflationary, inflationary pressures. uh, you don't get any of this with a bank. You get nothing. They give you nothing. You are witnessing the introduction and empirical evidence associated with an emergent, iterative, and disrupting system dealing with financials. It's far superior to the legacy system in all regards. Now, how it overlaps, how it disrupts, we'll see how it plays out, but data tells us what's occurring, and that is what's occurring. The value flowing into the crypto space and the DeFi protocols and Celsius and BlockFi and so on and so forth is meaningful. It's not trivial. It's not trillions of dollars, so it's not a good part. But probably the best thing to be said is it's the smart money. It's the folks front running the big money. So if you're in now, I personally think it's just starting. I think we're on the precipice of the great value reallocation, where um, value becomes growth, commodities, mining, metals, and crypto. I'm seeing the data. I see what's going on in the mining sector and commodities. You got supply disruption across the board, across the planet. Commodities are sometimes going vertical with regard to specifically as a result of supply disruption. And mining is parabolic. We're talking about battery metal miners. I mention it often. They're parabolic. 1,000%, hundreds of percent across the board, hundreds and hundreds, if not 1,000+% at this point for some of these assets. Yeah, if that's not empirical evidence that we're on the precipice of the great value reallocation, I don't know what is. And my gut says commodities, mining, metals, crypto, and all the value that's to come from the deflating broad equity space. This is going to take a long time to play out, and it could be easily the better part of the next 10 years, where all that value just bleeds out in a massive bear market, which we haven't had in 10 years since they started QE in '08 or late '08, '09ish. So a lot of room for upside. And this chart really says it all. It hasn't even, there's zero inflation for Bitcoin right now. It's not inflated at all. And what do we know? We know value transfers from inflated assets to uninflated assets, part of a mean regression process. When something is above the mean, it depreciates. When something is below the mean, it appreciates. And what we know is the mean is much higher than where Bitcoin is because of how ridiculously inflated the broad equity space has become. It moved the mean up significantly higher, and that would be an interesting line to draw on the chart. And that's kind of really what Plan B and Willy Woo chart, and like those rainbow curves and whatnot is trying to get a sense of where it's heading. But in the end, what I know is I work in up and down. I love the concept of mean regression, and I firmly believe things return to the mean. It's a natural phenomena, and that's baked into human emotion and just how people behave. So if equities and the broad tech equity space is disturbingly irrationally overinflated, that value is going to bleed somewhere when there's a destabilizing event. Um, I've seen some charts where people say that the S&P and these inflated equities keep going higher when you denominate them in like M2 money supply. I don't know. I don't know. Can the market get even further distorted? Sure. For years? Sure. Um, but for me, what's important is at least understanding these concepts. It may keep going. The stock market may just become stupider and stupider. But we have to look at data, and what we do is we ride a trend. The trend continues until it stops and reverses. We look for confirmation or invalidation. And that's when we adjust. That's when a story change is occurring. And that's when we make modifications to have our portfolio reflect the, or uh, um, what's the word? Express. So we have a portfolio express our view of the market that we're able to assess digesting the technical data. Anyway, I know this is deep shit and I go on a lot of rants and monologues, but it's pretty cool. Very exciting stuff. Trevor mentioned Aave. Aave is a big deal. I mean, if you talking just fundamentals, not even technicals, it obviously ripped like 5,000% over the last year and change. But fundamentals alone, I mean, they have a banking license in the UK. You can only imagine they expand just globally over time. And you can only imagine if they have a debit card and you get 5, 10, 15% at any given time on some of these stable coins, why are you going to put money in the bank? Why? So Aave is a systemic disruption, an ongoing systemic disruption for legacy financial banking systems, and I think it's only going to just advance and evolve and grow. It just seems all too obvious at this point. Thoughts on ZRX being a part of most of the DeFi projects? ZRX has a very efficient limit order system. Rook goes through ZRX. I think there's meaning for, or something to consider for Rook going through 1inch with regard to Chi. But I think they could also apply just Chi to 0x. Chi is not 1inch centric. It's just a matter of activating the token and consuming it, which alleviates the gas fee associated with a transaction. So ZeroX is a big deal. ZRX has stood apart from Kyber and Bancor. That ZRX has been moving, likely because its volume through Maca has been ramping significantly. And actually, if you're staking ZRX, it's quite lucrative. Denominated in Ethereum, no less. So Bancor and Kyber are very interesting. They're extremely cyclical. If you look at the charts versus last year and earlier, they're eerily similar. So I think Bancor and Kyber look to be printing cyclical bottoms. You got to wait for bullish confluence, which is basically a break to the upside through a long-term moving average on the long time horizon. So yeah, I'll show you real quick what I look at. Do I have Bancor up? I do keep Bancor up. So this is where Bancor is. Obviously, it's higher lows. It pushed through the 50 and the 100 SMA on the daily. It broke the 200 EMA to the upside, retested, and now you got to print the higher high. But interestingly, somewhat unfortunately, you have the 200 SMA shortly above. So you need to re-break again. You need to break to the upside, retest, and print the higher high. And then you have significant bullish confluence that you can have continued price appreciation. This has an enormous room to run. You're talking like enormous. You know why it's enormous? I'll show you. Because that little bump you saw back there ain't nothing on 2017 against Bitcoin. You're talking about a 10x to get to 2017 levels. This right here was 2020. That ain't nothing on 2017. So, you know, risk aside, watch the downside. You know, if you're going to apply, maybe the best downside protection that I am subscribing to is pair LP positions, like Ethereum DAI. I wish there was like a WBTC DAI position, but then again, I'm kind of skewed for Bitcoin because Bitcoin is Bitcoin. Bitcoin is an ongoing disruption. Almost nothing ever disrupts an ongoing disruption, so Bitcoin stands apart. It's unique empirically. So, and also from a long-term perspective, you get 200% annualized appreciation for the last 10 years. So I don't really want to cover downside because if you hold it long enough, you're just going to get killer returns over the next 10 years. Ethereum, I do like the pair. Most of basically the entire portfolio I have is structured along these lines of downside protection. I am prepared for market corrections. I will absolutely minimize the crap out of downside, protect the gains that have been worked so hard for. I will experience muted upside, so I'm sacrificing some of that upside by not having full single-sided exposure to these assets, but I will do that any day of the week to protect against downside. I think that is the best trade anyone can ever do. So do consider that. Protect your gains, protect your downside, have an aggressive risk management strategy. And that's the most important thing I could tell you guys, because that's the difference between the other social media commentators. They have no idea what they're doing. They literally have no idea whatsoever about investment advice that's either rational or legal. You know, they're talking about coins and coins going up in price. I don't talk about any of that shit. I think that that's borderline. It's borderline fraudulent and possible. It's definitely illegal because that's financial advice. I don't provide financial advice. I provide strategic and intelligent financial strategy. I'm a teacher. I'm teaching you guys how to think about this shit so you can make the best decisions possible for yourselves. And we look at assets. We talk about the fundamentals. We talk about technicals, when to look at them to have a higher likelihood than less likelihood of continued price appreciation. So we talk strategy, and that makes it's a big difference. And I like to remind myself and I appreciate that what we're doing here is not bullshit. It's not a shill fest. It's not all that just horrible stuff we see across YouTube and Wall Street bets. It's going to be tragic. I'm telling you right now, it's going to be an absolute tragedy for the vast majority of participants that just jump into things and ape into things and don't understand fundamentals, don't look at technicals, have no effective or robust risk management strategy deployed. It's going to be really, really brutal, and it's going to exacerbate disparity. It's going to be tragic, and we like to think that the only tragedy going on is unemployment, but it's going to be brutal what happens with the equities markets and the crypto space, just like it was brutal what happened with the crypto space in 2018 when it just came straight down. Franz says income from dark nodes will get bigger and bigger. I personally subscribe to that. A great thing about dark nodes is that it takes like months to liquidate them. So you are aggressively incentivized to retain them. So I got them as such a cheap cost basis that I don't even think about them. And they just keep going up in value, which I try and forget about. And I try and focus on the recurring revenue stream that it generates. And I like to think in a couple of years, each dark node is going to be full-time jobs unto itself. 100 grand a year. Why not? Come on. Time horizon, boys and girls. Time horizon. Digibyte, any cold storage wallets you like behind Ledger, Trezor? Just Ledger. They had the data breach and they got a lot of flack for that, but it's the most robust between the device itself and the software they provide to manage it, as well as MetaMask integration and just broad support across the DeFi spectrum. Ledger is the premier digital asset hardware storage technology. It is what it is. Captain Webb is in the house. My man. Oh my God. Captain likes that Cosmos, which has been killing it. So Cosmos has a multi-year time horizon. It's just, you can't look at it in the short term. Same with Polkadot. We're talking about basically Ethereum 2017 status. And Cosmos, along with the China narrative, literally Cosmos is baked into the national blockchain infrastructure of China. If you don't know about that, look into the BSN, look into IrisNet, IRITA, and these are the types of products that the Chinese government are trying to offer to businesses. That's exactly what IRITA is, business solutions. And IrisNet interacts with, is a Cosmos hub, which is basically a chain operating on the Cosmos blockchain of blockchains, analogous to what Polkadot is doing with the parachains and the substrate blockchains. Analogous, not technologically equivalent. But Iris now, what does it do? Since it's a Cosmos hub, it has the Cosmos Stargate, which means it facilitates interoperability across the entire Cosmos network of networks. And then BSN is designed to tie all of the big L1s together. So you got Ethereum's in there and a whole slew, just BSN, Twitter. You'll see the slew of networks that China has chosen for its national blockchain infrastructure. And I would like to probably, somewhat in conclusion, national blockchain infrastructure. Do I have to emphasize that, or can I possibly emphasize that anymore? When I say that, I mean it's like the US government having a department of blockchain. That's what's going on. So folks completely and grossly and in some degree negligently underestimate what's going on with regard to this technology. Um, folks see investments in stocks and shit, but we're really talking about balance of power for countries. And China right now is engaging. When I say engaging, I mean like not in a militaristic kind of way, but they're on the offensive, and the U.S. is probably at least on the defensive, if not full on negligent in their response to offering competitive technologies, or at least a competitive policy approach. So they're full on right now in China for blockchain tech at the national level, and that is some serious shit. Um, Squanchy Adam has been killing it. Yeah, man, I've had Adam. I don't even remember when I bought Adam. And it was not the trivial bag. I'm just saying, oh yeah. Not so easy to liquidate because when you're delegating, you have a 24-day lockup period when you want to release assets, albeit it's a staking protocol, inflation. So you're getting yield. So you never give up your core position. You use your assets to make money, to produce recurring revenue streams, and that's exactly what Cosmos does. It's going to keep producing more atom, more atom, more atom, and that you can liquidate for a recurring revenue stream. Crazy times, downside price action protection, inherent options in the AMM pool protocols, Bancor single-sided liquidity, full exposure. Wow. It's jaw-dropping. It's stunning. And the best is really yet to come. And I got my eye on everything. I got my eye on Rook, which is getting hammered right now. I significantly reduced my position to be more in line with my risk tolerance. I have a very healthy position currently that's consistent with historically how I apply value to risk on assets. I mean, this is probably holding around the sevens. I'll take a look at the price action for folks interested. I mean, listen, I got into this thing at $65. I'm just saying. So watch your risk. I talk about assets infrequently. I mentioned Bancor, I mentioned Kyber, I talk about Digibyte, and I've talked about Rook, about the fundamentals of the project. I always say fundamentals tell you where to look, technicals when. But you need to listen to the other stuff that I talk to. Risk management. Your goal isn't to make money. Your goal is to make optimal risk adjusted returns. You need to protect as much as you want to gain. So don't be negligent to yourself. Don't be negligent to your self fiduciary responsibility. Anyway, where is it? Keep it 639. Yeah, it took a fat hit. So that thing was hovering around 7 for a while, but compared to a $65 entry, yay. Oh, I mean, I was talking about it back then. I talked about it on the stream, so I'm pretty sure a lot of you folks got some decent gains out of it. But you have to consider the other stuff I talk about and how to manage these assets, how to protect against downside, what percentage of your portfolio it is, how much risk are you actually taking. If you can't answer that question, you need to stop immediately and pursue answering that question. How much risk are you actually taking? How much of your assets have been protected? What if there's a risk off event? How much downside will occur in such an event? Will the downside be muted or exacerbated? If you're overexposed to alts, the downside will be exacerbated. If you're applying to pair LP positions, your downside is going to be muted, but you're still going to be exposed to things such as Ethereum that are asymmetrically appreciating assets. So more to come. Love these topics of conversation, and I hope it helps. This is not this is financial advice, but it's not I never will tell you guys what to do. What I will tell you guys is the strategy and how to think and educate and how to do things better. It's time for Main Street to become the smart money. And that's what the show is. The show isn't financial advice. The show is that education. Thank you all for joining me. We got 39 people in the stream, 17 likes. We can do better. As always, 12:08 p.m. Friday, February 16th. Tell everyone to subscribe. I thank you very much for joining. I will see you tomorrow. Y'all have a good day now. Peace.